Hi there. So in this video I'm going to give you a very basic introduction into trading with candlestick charts, and then I'm going to show you a couple of very simple candlestick trading strategies that you can use to get you started. So what are candlesticks? Well, they're a method of charting or technical analysis where focus is given to the opening and closing price of each period. They're used to analyse the sentiment of the market at any given time. Now that's an important point to note with candlesticks, is that they give you an idea of the sentiment of the market at that point in time, not in the future, but at that point in time now. So there's no kind of future predictive qualities to candlesticks, but they do give you a good idea of what traders are thinking, of what the sentiment of the market is at this point in time. So let's have a look at how candlesticks are formed and what they show us. Now, candlesticks use the open, the close, the high and low values of a set period, and you've got a couple of examples just below. In example A, you can see that the price opened at 50, closed at 9, it went as high as 100, and it went down as low as 40. These tails or wicks or shadows, as they're sometimes known, are the extremes that the price went to. In this filled-in area here, the real body of the candle is where the price opened and where the price closed. Now this candlestick, example A, is a very bullish candlestick, and in this diagram it's coloured in white. Depending on your trading platform, it could be green or blue. Generally speaking, a bullish candlestick is green. Example B is the opposite. It opened at 90, it closed lower at 50, the price went as low as 40, as high as 100. And this is what we call a bearish candlestick. The price went down during that period of time. And here it's coloured in black, but on your chart it could be red or whatever other colour you choose. Example C, we have a very small real body, and the price opened pretty much at the same price that it closed, and you have these long tails or shadows to the upside and downside. Now this candle here is what we call a doji, and it represents indecision in the market. So when you're looking at candlesticks and analysing your candlesticks, it's always important to bear in mind the size of the body of the candle and the length of the tails. So let's have a look at that again, and this time we'll use some examples from the market. So we'll actually have a look on our trading platform, and we'll pick out a few candlesticks on our chart here, and we'll analyse the sentiment of the market. So I'm going to zoom in a little so that we can see candlesticks better. Now we're on an hourly time frame, so each one of these candlesticks represents 1 hour in time. You could be looking on a 1 minute time frame, and each candlestick will represent 1 minute in time. You could be on a 1 day time frame, and each candlestick will represent 1 day in time. And something to bear in mind is that when you're looking at candlesticks, the longer the time frame, generally speaking, the more reliable the candlestick is going to be. And the reason behind that is because if you think about it, if you're looking on a 1 minute time frame, there's only going to be a small amount of trading happening during that period of time. If you're looking on a 1 day time frame, there's a lot more data incorporated in that candlestick, so in theory it should give you a much more reliable signal. Having said that, candlesticks will work on any time frame. I'm just saying that the longer the time frame, generally speaking, the more reliable they're going to be. Okay, so let's just have a look at a couple of examples here. So you can see, say, this candlestick here, this small red body, long tail to the downside, and what this is telling us is that traders tried to sell it off here, but they couldn't, and buyers came in and they pushed the price all the way back up, almost to the point where it opened. Then we had a big green bullish candle which engulfed this candle, and the price continued going up from here. Big green bullish candle, big green bullish candles, and the price has been going up fairly strongly. Then over here, we had a fairly large red body to the candle, but look at the sentiment of this candle. The price sold off, but traders pushed it all the way back up there. So that tells us, this long tail to the downside tells us that there's buy-in pressure coming in here. This candlestick up here is a textbook reversal candlestick. The price has been going up. Traders tried to push the price up further, but they couldn't sustain that buy-in pressure, and we've got a long tail to the upside, and that's because traders pushed the price all the way back down here. So that tells me that there's good selling pressure up at this level here, and then the candle actually closed lower than it opened, so that's a bearish candlestick. So that's just a few examples, and what I'm going to do now is show you some candlestick strategies. So let's just go back to our slides. Okay, so now that we understand how to interpret candlesticks, let's have a look at a couple of common candlestick formations and see how we can trade those and make money from the markets. The first strategy I'm going to show you is the engulfing candlestick pattern. Now this is a candlestick chart pattern that forms when a small candlestick is followed by a large candlestick that completely engulfs the previous candlestick. The shadows or tails of the small candlestick should be short, which enables the body of the large candlestick to cover the entire previous candlestick. So we've got an example here, bullish engulfing. The market's been coming down, small candlestick and a big bullish candlestick that engulfs the previous candlestick completely. Opposite here, market's been going up, small candlestick, and then a big bearish candlestick that completely engulfs that candlestick. So a couple of things to consider when you're trading this strategy. You need to think about which time frame you're going to use. The strategy does work on any time frame, however, in my experience anyway, the longer the time frame, the more reliable the setups will be, as we mentioned earlier. And if you think about it, the reason for that is because there's more data incorporated in a daily candlestick, for example, compared to a 1 hour or 1 minute candlestick. However, if you're looking at this strategy, anything from a 1 hour time frame upwards should work pretty well. So let's have a look at the strategy on the platform and see how we can trade this. Okay, so let's just have a look at our chart here and pick out a few examples and see how we could trade this. So first example I'm going to use is this one here. So small body, big bullish candle, and the price went up from there. Now the way that I would trade that is I would buy at the close of this candle, because this is a bullish engulfing candle. I would put my stop loss just below the low of the tail of the candle, maybe 10 pips below, and I target 1 to 2, i.e. if I'm risking 50 pips I target 100 pips. And the reason for that is because then I only need to be right 40% of the time and I'm breaking even, but you should be right more like 55 to 60% of the time of this strategy. So because you're risking half as much as you're gaining on every trade, over time you'll be profitable. So that's the first example there. So you would buy it here, stop loss just below, and the price goes up. Over here, not a perfect example, but very small real body, big bullish candle, engulfs the previous candle, same thing, price goes up. You may not have quite made your take profit target on that one because you've got quite a big stop loss. Another example down over here, red candle, big bullish candle, buy it here, stop loss just below here, price trades higher. Over here, not a great example, but a small body, this candle does engulf that candle and the price does sell off from here. Over here, red body, big green bullish candle, you would have got stopped out on that trade, so that just shows you that it doesn't work every time, and nothing ever will in trading, but if you stick to the strategy you will make money over time. And we're just actually getting one setting up over here. We've still got 35 minutes until this candle closes, but if it were to close like this, we would sell at the close, stop loss just above, and we target double of our stop loss and expecting the price to come down here somewhere. So that's one to watch as that candle develops. And that's an important point to note as well, is that you wouldn't take the trade until the candle is actually closed. Okay, so that's the engulfing candlestick strategy. Now let's look at another strategy, and This one is what we call the pin bar strategy, and a pin bar is a candlestick with the following three criteria: an open and close within the previous candlestick, a tail or wick which is a minimum of 3 times the length of the candlestick's real body, and a long tail or wick which is protruding from the other candles. And you can see you have a bearish one here, long tail to the upside, bullish one here, long tail to the downside. And the sentiment behind this is that the price went all the way up there, but traders pushed it all the way back down. Sellers were stronger. The price went all the way down here, but buyers came in and they pushed the price all the way back up, so buyers were stronger. Again, as with any candlestick strategy, this should work on a longer time frame. However, you can see these on any time frame, but on a, say, hourly time frame upwards, they're going to be a bit more reliable. So let's have a look at this one on the platform, see if we can spot a couple of strategies. I've just been put into a trade on another strategy, so just ignore that for now. But let's have a look at this one. The example we looked at previously, it's not perfect, but because you've got a bit of a tail to the upside as well, but it is still there, the long tail to the downside, and then the price has gone higher from there. And the way you would trade it is you would buy it at the close of the candle, stop loss below the tail or wick of the candle, about 10 pips below, and again you target double your stop loss, and you can see the price went higher from there. We've got one just set up recently over here. Market's been going up, bearish red body, long tail to the upside that protrudes all of the other price action. You would have sold it at the close of this candle, stop loss just above, and you'd be targeting 1 to 2, and you'd probably be in a decent amount of profit on that trade at the moment. Down here is another one, small body, long tail to the downside. You would have bought it just there, stop loss just below. Markets traded higher from there. So I hope that gives you a good introduction into candlestick charting and how you can trade using candlesticks. Of course, if you have any questions about this, or if you need any additional support, please do get in touch with your account manager here at STX Markets in London. That's it from me for now. Stay safe in the markets, and I'll speak to you soon.